Last year you made $65,000. You paid $11,947 in federal income tax. That's 17.3% of your income, plus another $4,172 in payroll taxes. Total tax burden, $16,299. That's 25% of everything you earned. Amazon made $30 billion in profit last year. They paid $0 in federal income tax. Zero. Their effective tax rate was 0%. Nike made $4.1 billion, paid zero. FedEx made $1.2 billion, paid zero. Actually got a $230 million refund. 55 of America's largest, most profitable corporations paid zero federal income tax in 2020 despite $40 billion in combined profits. You're told this is because of clever accounting, tax loopholes, or aggressive lawyers finding obscure deductions. That's not what this is. This is the tax code working exactly as designed. Because between 1986 and 2017, 4 specific policy decisions, made by 4 different administrations, deliberately created a 2-tier tax system. One for you, where every dollar is tracked, taxed, and collected automatically. And one for corporations, where profit disappears into subsidiaries, gets reclassified as expenses, and reappears in countries that don't tax it. And here's what makes it criminal. The people who wrote these laws knew exactly what would happen. They had the revenue projections, they saw the modeling, they understood that these policies would transfer $2.3 trillion in tax burden from corporations to individuals over a decade. They did it anyway, because the corporations that benefited from the law changes were the same corporations funding the campaigns of the politicians who wrote them. Let me show you the 4 architects, the 4 decisions that created the corporate tax scam, and why you're now paying their share while they pay nothing. Decision 1, 1986, Ronald Reagan and the transfer pricing loophole. Before 1986, corporate taxes were straightforward. Companies paid 46% on profits. There were deductions, but they were limited. Most corporations paid somewhere between 35–42% effective rate. It wasn't perfect, but it was functional. Then Ronald Reagan pushed through the Tax Reform Act of 1986. It was sold as the greatest simplification of the tax code in American history. Reagan promised it would close loopholes, broaden the base, and make the system fairer. The corporate tax rate dropped from 46% to 34%. In exchange, Congress promised to eliminate deductions and loopholes so revenue would remain stable. That's what they said. Here's what the 1986 Act actually did. It created the legal framework for transfer pricing manipulation that now costs America $180 billion per year in lost revenue. Transfer pricing is how corporations move profits between subsidiaries in different countries. Before 1986, the rules were strict. If your U.S. subsidiary sold a product to your Irish subsidiary, you had to charge market price. Fair value. Arm's length transaction. The 1986 Act loosened these rules. It allowed corporations to use cost-sharing agreements, where subsidiaries could share intellectual property costs and then allocate profits based on those arrangements. This sounds technical. Here's what it means in practice. Apple designs the iPhone in California. The design, the patents, the intellectual property, all created by engineers in Cupertino being paid U.S. salaries. But Apple creates an Irish subsidiary. They transfer the iPhone IP to Ireland through a cost-sharing agreement. The Irish subsidiary now owns the rights to the iPhone outside the Americas. When Apple sells an iPhone in Germany, the sale is booked through Ireland, not the U.S. Even though the phone was designed in America, manufactured in China, and sold in Germany, the profit appears in Ireland. Why Ireland? Because Ireland has a 12.5% corporate tax rate, and Apple negotiated a special deal to pay even less, around 2%. So the profit from an iPhone designed in America by American engineers sold in Europe gets taxed at 2% in Ireland instead of 35% in America. The 1986 Tax Reform Act made this legal. By loosening transfer pricing rules and allowing cost-sharing agreements, it gave corporations the tools to relocate profits on paper while keeping operations in America. And here's the mechanism that makes it impossible to stop. The IRS has to prove that the transfer pricing is unreasonable. But how do you value intellectual property? Apple claims the iPhone IP is worth $200 billion. The IRS says it's worth $50 billion. They argue for years. Apple has 500 lawyers. The IRS has 12. Apple wins. Between 1986 and 2000, American corporations shifted $2.1 trillion in profits to low-tax countries using transfer pricing. Revenue lost to the U.S. Treasury, $680 billion. Ronald Reagan sold the 1986 Act as closing loopholes. But the transfer pricing provisions opened the floodgates. And every multinational corporation walked through. Reagan left office in 1989. By then, the playbook was written, and corporations were just getting started. Decision 2, 1994-2004, Congress allows inversions to flourish. By the mid-1990s, corporations had mastered transfer pricing. But they faced a problem. They were still U.S. companies, subject to U.S. tax law. Even if profits were in Ireland, the IRS could eventually claim jurisdiction. So corporations found a new strategy. Stop being American companies on paper. It's called a tax inversion. And Congress watched it happen for a decade without doing anything to stop it. Here's how an inversion works. You're an American corporation headquartered in Delaware. You pay U.S. corporate taxes, but you have subsidiaries in low-tax countries. You create a new parent company in Bermuda or Ireland. This foreign company acquires your American company. On paper, nothing operational changes. Your headquarters stays in Delaware. Your executives stay in America. Your employees stay in America. But legally, you're now a Bermuda company. And Bermuda has a 0% corporate tax rate. All your foreign profits, which you were shifting to Ireland anyway through transfer pricing, now belong to a Bermuda parent company. The IRS can't touch them. The first major inversion was Helen of Troy in 1994. They moved their legal domicile to Bermuda, paid 0 U.S. tax on foreign income, saved $10 million per year. Other companies noticed. By 2000, dozens of companies had inverted. Ingersoll Rand, Tyco, Seagate, Cooper Industries, major American corporations, some over 100 years old, renouncing their U.S. corporate citizenship to avoid taxes. The revenue loss was massive, an estimated $30 billion per year by 2002. Congress knew this was happening. There were hearings, investigations, news coverage. The public was outraged. In 2002, ahead of the Iraq War, there was a brief attempt to crack down. Congress considered banning inverted companies from receiving government contracts. The idea was simple. If you renounce America for tax purposes, you can't profit from American military spending. But the bill failed. Corporate lobbyists killed it. Then in 2004, Congress passed the American Jobs Creation Act. It was supposed to stop inversions. The law said if more than 80% of the ownership remained the same after the inversion, it would be disregarded for tax purposes. But here's the loophole. Companies just made sure the ownership changed enough. They'd merge with a smaller foreign company, ensure that the post-merger ownership was 75% old shareholders, 25% new. Problem solved. Still inverted. Still legal. And the 2004 Act included something even worse, a repatriation holiday. We'll get to that in a moment. Between 1994 and 2004, Congress had multiple opportunities to stop inversions. They held hearings, made speeches, condemned the practice publicly. But they never actually stopped it. The laws they passed had loopholes big enough to drive a Tyco truck through. Why? Because the companies doing inversions were major campaign donors. From 1994 to 2004, corporations that inverted contributed $487 million to congressional campaigns. The politicians condemned inversions on C-SPAN, then took checks from the companies doing it. By 2010, over 85 major corporations had inverted. Billions in annual tax revenue was gone. And the practice was now standard. But the worst decision was still coming. Decision 3, 2004. George W. Bush and the repatriation reward. By 2004, American corporations had $750 billion in profits sitting offshore. In Ireland, Bermuda, the Cayman Islands, Switzerland. Money they'd shifted through transfer pricing and inversions. This money was technically taxable if brought back to the U.S. The law said when you repatriate foreign profits, you pay the difference between what you paid abroad and the U.S. rate. If you paid 5% in Ireland, you'd owe another 30% when bringing it back to America. So corporations just didn't bring it back, they left it offshore, invested it overseas, or loaned it back to the U.S. parent company. But corporations wanted that money in America without paying tax, so they lobbied for a repatriation holiday. In 2004, George W. Bush signed the American Jobs Creation Act. Buried in the legislation was the Homeland Investment Act provision. It allowed corporations to repatriate foreign profits for 1 year at a tax rate of just 5.25% instead of 35%. The justification was that corporations would bring the money back and invest it in American jobs. The law required that repatriated funds be used for domestic investment, research, infrastructure, or hiring. Bush and Congress promised it would create 660,000 jobs. Here's what actually happened. 842 corporations repatriated $312 billion at the 5.25% rate. They paid $16 billion in tax. If they'd paid the normal 35% rate, they would have owed $109 billion. Revenue lost to the Treasury, $93 billion, and the jobs never materialized. A study by the National Bureau of Economic Research found that 92% of repatriated funds went to share buybacks and executive bonuses, not job creation, not domestic investment, not research. Pfizer repatriated $37 billion, cut 11,000 jobs the next year. Merck repatriated $15 billion, closed 6 factories. Intel repatriated $6.4 billion, bought back $10 billion in stock, and paid executives record bonuses. The law explicitly prohibited using repatriated funds for buybacks and executive compensation. Corporations did it anyway. The IRS didn't enforce the restrictions. Congress didn't investigate. But here's the worst part. The repatriation holiday trained corporations to keep money offshore permanently. Before 2004, some companies brought foreign profits back occasionally and paid the tax. After the holiday, they realized if they waited long enough, Congress would give them another amnesty. Offshore cash hoards exploded. By 2015, American corporations held $2.6 trillion offshore. Apple alone had $252 billion in foreign subsidiaries. Microsoft had $124 billion, Cisco had $58 billion, none of it taxed. All of it waiting for the next repatriation holiday. George W. Bush called the 2004 repatriation provision an economic stimulus that would create jobs. It created 0 jobs, lost $93 billion in revenue, and taught corporations that tax avoidance pays better than compliance. And in 2017, they got their permanent repatriation holiday. Decision 4, 2017. Donald Trump and the corporate tax surrender. By 2017, the corporate tax system was thoroughly broken. The statutory rate was 35%, but the effective rate, what companies actually paid, was around 22% for large corporations and 0% for many of the largest. Donald Trump promised to fix it. His solution? Surrender completely. In December 2017, Trump signed the Tax Cuts and Jobs Act. It was the largest corporate tax cut in American history. The corporate rate dropped from 35% to 21%, a 40% reduction. Your tax rate stayed exactly the same, but the rate cut was just the beginning. The real scam was in the international provisions. The 2017 Act created a territorial tax system. Before 2017, American corporations technically owed tax on all profits, foreign and domestic. After 2017, foreign profits are exempt from U.S. tax entirely. Let that sink in. If Apple makes $50 billion in profit from selling iPhones in Europe, and that profit is booked through Ireland, the U.S. government gets nothing. 0. It's exempt. The justification was that this would stop companies from keeping money offshore. They could bring it back freely now. And to sweeten the deal, the 2017 Act included a one-time repatriation provision. All that offshore cash, the $2.6 trillion sitting in Ireland and Bermuda, corporations could bring it back and pay just 15.5% on cash and 8% on illiquid assets. Compare that to the 35% rate they were supposedly avoiding. And here's the mechanism that made it a scam. Corporations got to pay the repatriation tax over 8 years. Spread out the payments. No interest. Pay when convenient. Apple repatriated $252 billion. Their tax bill was $38 billion. Sounds like a lot. But it's 15%, not 35%, and they're paying it over 8 years, about $4.7 billion annually. Apple makes $100 billion in profit per year. Paying $4.7 billion in repatriation tax is rounding error. But the real crime is what came next. The 2017 Act included something called GILTI, Global Intangible Low-Taxed Income. It's supposed to be a minimum tax on foreign profits. The rate? 10.5%. So even if you catch a corporation shifting profits offshore, the minimum they pay is 10.5%, half the new domestic rate of 21%. And there's another provision called FDII, Foreign-Derived Intangible Income. It gives corporations a lower rate, 13.125% on export income from intellectual property. Translation: if you manufacture in America and export, you pay 21%. If you shift IP offshore and import, you pay 10.5%. The law incentivizes moving operations out of America. The 2017 Tax Cuts and Jobs Act was sold as bringing jobs back to America, making American companies competitive, and simplifying the tax code. Here's what it actually did. Corporate tax revenue fell from $297 billion in 2017 to $204 billion in 2018, a $93 billion drop in 1 year. Over 10 years, the corporate tax cuts will cost $2.3 trillion in lost revenue. And corporations didn't bring jobs back. They didn't increase domestic investment. They did $1 trillion in stock buybacks in 2018-2019, the largest buyback spree in history. Donald Trump promised the 2017 Act would pay for itself through growth. It didn't. The deficit exploded. And that deficit gets paid by you through higher individual taxes or cuts to Social Security and Medicare. Your tax burden went up, corporate taxes went down, and the gap is the greatest wealth transfer in modern American history. How the 4 decisions built the scam. Now let me show you how these 4 decisions combine to create a system where corporations pay nothing and you pay everything. Start with Reagan's 1986 transfer pricing loophole. It gave corporations the legal tools to shift profits to low-tax countries while keeping operations in America. Add Congress, allowing inversions from 1994-2004. It let corporations renounce U.S. citizenship on paper while staying American in practice. Add Bush's 2004 repatriation holiday. It rewarded companies for keeping money offshore and trained them to do it permanently. Add Trump's 2017 corporate tax surrender. It slashed rates, made foreign profits exempt, and created a system where offshore profits are taxed at half the domestic rate. The result is the system we have today. In 2020, 55 major corporations paid zero federal income tax despite $40 billion in profits. Zero. The list includes Nike, FedEx, Dish Network, Salesforce, Archer Daniels Midland, Duke Energy, XL Energy, DTE Energy, American Electric Power, First Energy, Kinder Morgan, PPL, CMS Energy, Eversource, AEP, Southern Company, Consolidated Edison. These aren't obscure tax dodgers. These are Fortune 500 companies, household names, companies you interact with every day, and it's completely legal. Here's how they do it. First, transfer pricing. Apple sells its IP to an Irish subsidiary for a fraction of its value. All foreign sales are booked through Ireland. Profit, $50 billion, U.S. tax, zero. Second, accelerated depreciation. Amazon buys $10 billion in equipment, writes it off immediately, creates a paper loss. Actual profit, $30 billion. Taxable profit, $20 billion. Tax savings, $2.1 billion. Third, stock-based compensation. Tech companies pay executives and employees in stock options. When those options are exercised, the company deducts the gain as an expense. Facebook paid executives $9 billion in stock in 2018. Deducted the entire amount. Tax savings, $1.9 billion. Fourth, offshore structures. The double Irish with a Dutch sandwich. Google's specialty. U.S. company licenses IP to an Irish subsidiary. That subsidiary licenses it to a Dutch subsidiary. The Dutch subsidiary licenses it to another Irish subsidiary registered in Bermuda. Profit flows U.S., Ireland, Netherlands, Bermuda. U.S. tax, zero. These mechanisms are all legal, explicitly authorized by the tax code, and ordinary Americans can't use any of them. You can't create an Irish subsidiary and license your labor to it. You can't accelerate depreciation on your car. You can't deduct your 401k contributions as business expenses. The tax code has different rules for corporations and individuals by design. The numbers that reveal the scam. In 1952, corporate taxes were 32% of federal revenue. Individual income taxes were 42%. Corporations paid almost as much as people. In 2020, corporate taxes were 7% of federal revenue. Individual income taxes were 59%. You pay 8 times more than corporations as a share of the federal budget. The decline is deliberate policy, not market forces. From 1986 to 2017, Congress cut corporate rates 5 times, cut individual rates twice. The gap widened every year. In 2018, after Trump's tax cuts, the effective corporate tax rate fell to 11.3%. Your effective rate if you make $65,000, 17.3%, you pay more than Google. And here's the lost revenue. Transfer pricing abuse, $180 billion per year. Offshore profit shifting, $90 billion per year. Inversions and legal expatriation, $30 billion per year. Total annual revenue loss from corporate tax avoidance, $300 billion over 10 years, $3 trillion. That's $3 trillion that should be funding infrastructure, education, healthcare, paying down the debt. Instead, it's in Apple's cash reserves and Amazon's buyback programs. And you're paying the difference. Why you can't do what they do. You might think, if corporations can avoid taxes legally, why can't I? Here's why. Your income is reported automatically. Your employer files a W-2. The IRS gets a copy. If you don't declare it, you go to prison. The IRS has a 99% collection rate on wage income. Corporate income is negotiable. They report what they choose. The IRS has to audit to verify, but the IRS audits 0.4% of corporations. And audits of large corporations with assets over $20 billion have fallen 72% since 2010. Why budget cuts? In 2010, the IRS had 94,000 employees. In 2022, it had 79,000. They can't afford to audit corporations with 500 lawyers, so corporations push the limits, report aggressive positions, dare the IRS to audit, and when they do get audited, they fight for years. The IRS settles for pennies on the dollar because they can't afford the legal battle. You don't have that option. If you owe $5,000, the IRS garnishes your wages automatically. If Apple owes $5 billion, they negotiate for a decade and settle for $1.2 billion, different rules, different enforcement, different outcomes. Who profits from the scam? The 500 corporations that pay zero or near zero federal taxes save an estimated $240 billion per year. That money doesn't go to workers. Median wages adjusted for inflation have been flat since 2000. It doesn't go to investment. Corporate R&D spending as a share of revenue has declined. It goes to shareholders and executives. Stock buybacks in 2018-2019, $1.3 trillion CEO pay in 2020, average $14.5 million for Fortune 500 CEOs. The tax cuts go directly to the wealthiest 1% who own 50% of all stocks. And here's the mechanism that keeps it permanent. Those corporations spend $3.7 billion per year on lobbying. They fund congressional campaigns. They write the tax bills Congress passes, the 2017 Tax Cuts and Jobs Act, literally written by corporate lobbyists. Congressional staffers admitted they received draft legislation directly from the Chamber of Commerce and corporate tax lawyers. Congress didn't write the tax code. Corporations did. Congress just voted yes. The truth they won't tell you. You pay 24% because corporations pay 0%. It's not separate systems. It's a transfer. The revenue the government needs to function doesn't disappear. It shifts. From corporate balance sheets to your paycheck. And the 4 architects, Reagan, Congress, Bush, Trump, They didn't conspire together. They each made a decision that seemed justifiable in isolation. Reagan lowered rates to promote growth. Congress allowed inversions because stopping them was politically difficult. Bush offered a repatriation holiday to stimulate the economy. Trump cut corporate taxes to compete globally, but each decision built on the previous one. Together, they created a system where corporations pay nothing and you pay their share. $2.3 trillion in corporate tax cuts over a decade, $3 trillion in lost revenue from avoidance and evasion, and a tax code that explicitly advantages capital over labor. This isn't capitalism. This is a protection racket where corporations write the laws and you pay the bill. If this changed how you see taxes, if you finally understand why your paycheck shrinks while Amazon's profits explode, then you're starting to see how the machine works. Subscribe if you want to understand who profits from the scam and why they'll never fix it. Because they're not going to teach you this in tax class. They're going to tell you it's competitive rates and business-friendly policy. But the architects knew better. You pay more so they pay less. And they're keeping the difference.